The most consequential trading week of 2026 for precious metals may have already begun before most Western investors finished their morning coffee, and the catalyst is not a Federal Reserve announcement, not a geopolitical escalation, and not a supply disruption. It is the simple act of reopening. The world's largest consumer of both gold and silver, a market responsible for an outsized share of global physical demand, has been entirely absent from price discovery for 6 consecutive trading sessions. During that window of reduced liquidity, bullion markets experienced a violent sell-off, followed by an equally sharp reversal. The Federal Open Market Committee revealed internal divisions that surprised even seasoned analysts. Lease rates in the London silver market spiked to levels that indicate genuine physical scarcity. The largest silver streaming agreement ever executed was signed by 2 of the mining industry's most prominent names, and the United States deployed carrier strike groups to the Arabian Sea while issuing explicit military warnings to Iran. Every single one of these developments occurred while Shanghai's exchanges sat dark for the Lunar New Year holiday. Now, as those markets prepare to resume operations, the critical question facing every precious metals participant globally is straightforward. How does a market representing more than 1 billion consumers absorb 6 days of seismic change in a matter of hours? Looking at where prices currently stand as Western markets head into the close, spot gold is trading in the vicinity of $3,170 per ounce, while silver has moved to approximately $85. These numbers carry particular significance when measured against where they stood on the final session before the holiday closure. On February 13th, when the Shanghai Gold Exchange, the Shanghai Futures Exchange, and the Shanghai Stock Exchange conducted their last abbreviated session before shutting down, gold was printing around $3,140, and silver was changing hands in the $78 to $79 range. On the surface, a roughly $67 appreciation in gold, representing just over 1%, appears modest. Silver's advance of several dollars, translating to somewhere between 5 and 8% depending on the reference point, is considerably more noteworthy. But those net figures conceal an extraordinary amount of intervening volatility that Chinese participants have yet to process, and the manner in which they digest that volatility in the opening hours of their Tuesday session, which begins during Monday evening Shanghai time, corresponding to approximately 7 to 8 in the morning Eastern, on Monday, February 23rd, will likely establish the directional tone for the entire week. The sequence of events that unfolded during the 6-day absence deserves careful reconstruction, because the order and magnitude of these developments matter enormously for anticipating the response. The initial shock came on Tuesday, February 17th, when bullion prices experienced a sharp and aggressive correction, with the entire Asian trading complex offline. Mainland China, Hong Kong, Singapore, Taiwan, and South Korea were all shuttered simultaneously, and with the United States observing President's Day on the 16th, the market faced what can only be described as a triple liquidity vacuum. Spot gold retreated dramatically, falling toward the $2,860 to $2,900 zone, a decline of more than $150 from the previous Friday's settlement near $3,140. Silver fared no better, dropping to roughly $74 at the London morning fix, with indications that intraday prints touched even lower levels. The proximate causes were threefold. The absence of Asian physical buying removed a critical bid from the market. Diplomatic progress on both the Iran nuclear file and the Ukraine-Russia conflict compressed the geopolitical risk premium that had been supporting prices, and a modest firming of the dollar index applied additional downward pressure. It was a textbook illustration of how thin liquidity conditions can amplify directional moves, and it represented the kind of washout that tends to shake loose weak positioning. What makes that Tuesday sell-off particularly instructive, however, is what happened in parallel. On the very same day that retail sentiment turned sharply negative and speculative longs were being flushed from futures positions, BHP Group finalized a $4.3 billion silver streaming transaction with Wheaton Precious Metals, the largest such agreement in history measured by upfront consideration. Under the terms, BHP will channel silver production from its 33.75% stake in the Antamina mine in Peru to Wheaton, initially delivering its full production share until 100 million ounces have been transferred, after which the stream reduces to 22.5% for the remaining mine life extending through 2036. The juxtaposition is difficult to ignore. At the precise moment that short-term traders were liquidating exposure, one of the world's largest mining conglomerates was locking in long-duration silver commitments at institutional scale. That divergence between speculative behavior and strategic institutional positioning frequently marks inflection points. The recovery began in earnest on Wednesday, February 18th, and the catalyst was genuinely significant. The minutes from the Federal Reserve's January 27th and 28th meeting, released at 2 in the afternoon Eastern Time, revealed a committee far more fragmented than consensus had assumed. Rather than presenting a unified front committed to maintaining restrictive monetary policy, the minutes showed genuine disagreement among participants. Some members advocated for the possibility that rates might need to be reduced, others favored a prolonged hold, and a third faction argued that additional rate increases could become necessary if inflation failed to moderate further. Perhaps most striking was the suggestion by several participants that the committee should consider adopting language explicitly placing rate hikes back on the table as a conditional scenario. This level of internal division introduces a meaningful degree of policy uncertainty, and markets responded accordingly. By Thursday morning, gold had recovered to approximately $2,992 at the 10 o'clock snapshot, up from around $2,957 the prior day. But the price recovery in futures only told part of the story. On the physical side of the market, conditions were tightening in ways that carry structural implications. Reports emerged mid-week of sharp spikes in silver lease rates in London, a development that carries unambiguous meaning for anyone familiar with precious metals plumbing. Lease rates do not rise when metal is plentiful, they rise when counterparties urgently require physical material and the available supply at prevailing rates is insufficient to meet that demand. Concurrently, backwardation signals appeared between London spot silver and COMEX futures pricing, meaning that the market was valuing immediate delivery above future delivery, the opposite of the normal contango structure. Backwardation in precious metals is broadly interpreted as an indication that near-term physical demand is outstripping available supply, and historically it has preceded periods of acute delivery pressure on exchanges. Shifting to the geopolitical landscape, Thursday and Friday of the holiday week introduced an entirely new dimension of risk. On February 19th, President Trump established what amounted to an explicit deadline for Iran, stating that Tehran had 10 to 15 days to reach a nuclear agreement, or, in his words, bad things would happen. These remarks were delivered at the inaugural session of his newly formed Board of Peace, and they were accompanied by a demonstrable military posture. 2 carrier strike groups were either deployed or en route to the region. The USS Abraham Lincoln already positioned in the Arabian Sea and the USS Gerald R. Ford transiting to join it, along with dozens of fighter aircraft and aerial refueling assets. Senior administration officials indicated that the full complement of forces necessary for potential military operations was expected to be in position by mid-March. Iran's response was immediate and multifaceted. Joint naval exercises with Russia commenced in the Gulf of Oman, and Iran's ambassador to the United Nations transmitted a formal letter to the Secretary General stating that any military aggression would be met with a decisive response and that all American bases and military assets within the region would be considered legitimate targets. The Strait of Hormuz, through which approximately 20% of the world's daily oil supply transits, became an active flashpoint. Gold responded forcefully, rallying strongly through Thursday and Friday's sessions as a war premium was repriced into the metal. Adding another dimension to the analysis is what Hong Kong did upon its own reopening. Hong Kong's exchanges had been closed from February 17th through the 19th for the Lunar New Year holiday and resumed trading on Friday the 20th. Despite gold already sitting at elevated levels following the midweek recovery and the Iran escalation, Hong Kong participants came in as net buyers. The Hong Kong Gold Exchange conducted its traditional Year of the Horse opening ceremony, and physical demand reportedly surged. This matters because Hong Kong functions as a reliable leading indicator for mainland Chinese sentiment. The two markets are deeply interconnected culturally, economically, and in terms of capital flows. If Hong Kong was willing to pay prevailing prices after assessing the same developments that mainland participants will now confront, the implication is that mainland demand may follow a similar pattern. The critical question now becomes how to interpret the signals that will emerge from Shanghai's reopening session. On the institutional level, central bank activity remains a persistent tailwind. The People's Bank of China has been a consistent accumulator of gold reserves for years, driven by a strategic objective of diversifying away from dollar-denominated assets. If Chinese policymakers assess the current geopolitical environment, a divided Federal Reserve, the prospect of military conflict in the Middle East, and ongoing concerns about the long-term trajectory of the global monetary system, as validating that diversification thesis, then official sector buying could provide a firm bid beneath the market. At the retail level, the Lunar New Year season traditionally generates organic gold demand through cultural gifting practices, and the Year of the Horse carries its own associations with prosperity and forward momentum. From the perspective of possible market outcomes, the analytical framework resolves into 3 distinct trajectories. The bull case rests on aggressive Chinese accumulation. If gold is trading below $3,120 and silver remains under $85 as Shanghai's night session opens, and if the Iran situation remains unresolved or has escalated further over the weekend, the conditions favor strong buying. The signature indicator would be the Shanghai Gold Exchange physical premium over London spot. Under normal conditions, this premium ranges from $5 to $15 per ounce. A reading above $20, and particularly one approaching $30 to $50, would confirm that demand is sharply outpacing supply on the exchange and that Chinese buyers are willing to pay a significant markup for immediate access to physical metal. On the Shanghai Futures Exchange, rising open interest in the March silver contract would indicate that traders are positioning for delivery rather than rolling to May, a distinctly constructive signal. Under this trajectory, New York's Tuesday open could see gold gap to the $3,200 to $3,280 range, with silver potentially testing $88 to $92. COMEX delivery standing by Thursday's first notice could reach 70 to 90 million ounces of silver, placing genuine strain on registered inventories and potentially accelerating the tightness into the April contract. The counter-argument centers on profit-taking and risk reduction. Chinese retail investors accumulated gold aggressively in late January at prices above $3,500 per ounce. Many have been carrying unrealized losses since then, and the recovery back toward $3,100 represents a narrowing of those losses that some may view as an exit opportunity. Lunar New Year is also traditionally a period when families rebalance household finances, and some physical gold held for investment purposes gets liquidated to cover holiday expenditures or to rotate into other asset classes. On the macroeconomic front, China's domestic picture remains mixed. Retail sales over the holiday period were reportedly solid, but the real estate sector continues to show weakness and youth unemployment remains elevated. If policymakers are concerned about capital outflows or wish to project confidence in the yuan, they may not welcome a surging gold price that implicitly signals diminishing faith in the domestic currency. Under this scenario, the SGE premium would print flat to below $10 or potentially turn negative, indicating that supply is exceeding demand. Shanghai Futures Exchange open interest would decline as longs roll to May. Gold could retreat to $3,000 to $3,050 by Tuesday's New York open, with silver pulling back to $80 to $83. COMEX delivery standing would moderate to 40 to 50 million ounces, manageable and orderly. The base case suggests a more ambiguous outcome, which is arguably the most probable given the sheer diversity of participants in the Chinese market. State institutions may be buying for strategic reserves even as retail investors take profits. Industrial consumers may be securing silver supply for manufacturing, while speculators reduce exposure. The net flow in this scenario is modestly positive but not decisively directional. The SGE premium would settle in the $10 to $20 range, consistent with normal operations. Futures open interest would hold roughly steady. Gold would trade in a $3,080 to $3,180 range through Tuesday, with silver holding $83 to $87. COMEX first notice deliveries would land in the 60 to 75 million ounce range, enough to test the system without breaking it. Looking at the sequence of upcoming catalysts, the timeline for Eastern Time Zone participants begins Monday morning at approximately 7 to 8 o'clock, when Shanghai's futures and gold exchange night sessions commence. Within the first 30 minutes, the SGE premium and SHF open interest data will begin printing, providing the earliest real indication of Chinese intent. By Monday evening at approximately 8:30 Eastern, the Shanghai Stock Exchange opens for equities trading, and the direction of the Shanghai Composite will reveal the broader risk appetite. A decline of 1% or more suggests defensive positioning favorable to gold, while a gain of similar magnitude indicates risk appetite that could draw capital away from safe havens. London's session layers in starting around 3 in the morning Eastern on Tuesday, and by the time New York opens at 9:30, the combined Asian and European verdict will already be substantially formed. Wednesday brings the first meaningful COMEX open interest changes that reveal whether March longs are standing firm or rolling to May. Thursday, as the final positioning day before first notice, historically produces the highest volume of the delivery cycle. Moves of $50 to $100 in gold and $5 to $10 in silver are well within normal parameters for that session, as shorts who cannot deliver scramble to cover and longs who do not wish to take delivery roll their positions. Friday, February 28th, or the effective March 1st notice day, delivers the definitive data point, the number of contracts standing for delivery, which will determine whether the system handles the cycle comfortably or enters April under acute pressure. What separates this moment from previous cycles is the confluence of factors arriving simultaneously. Physical tightness in silver. confirmed by lease rate spikes and backwardation signals in London, is occurring against the backdrop of the largest streaming transaction in mining history, a fractured Federal Reserve that cannot agree on the direction of interest rate policy, an active military deployment to the Persian Gulf with an explicit deadline attached, and the return of the world's dominant physical precious metals consumer after nearly a week of absence, during which the fundamental landscape shifted materially. Each of these factors individually would merit close attention. Their simultaneous convergence creates a market environment where the range of possible outcomes is unusually wide and the speed of price adjustment could be unusually fast. As always, nothing presented in this analysis constitutes financial advice or a recommendation to buy, sell, or hold any asset. Markets can and frequently do behave in ways that confound even the most carefully constructed analytical frameworks. The scenarios outlined represent informed assessment of probabilities based on available data, not predictions of certain outcomes. Every participant should conduct independent research, consult qualified advisors as appropriate, and ensure that any decisions reflect their individual risk tolerance, financial circumstances, and investment objectives. What the data does suggest, however, is that the hours and days immediately ahead represent a period of elevated significance for precious metals markets, one that rewards preparation, discipline, and attentiveness to the signals the market itself provides.